Action to the Tesla earnings call Q2. I think 4 big points I want to make. Number one, they're going to have less volume in Q3, which I think the street is interpreting as drawdown on inventory, which of course has implications on demand. Second, Cybertruck is still relatively sluggish. I think we expect some production and deliveries this year, but really nothing big. I think third, the AI dynamics are interesting. XAI is just one manifestation. Musk talked about it. He said that he wanted to hire people for Tesla, and that they didn't want to work for Tesla. They wanted to work for a startup. So there's something going on where he needed more talent, more interesting people to work for the AI endeavor within Tesla, and he had to start a brand new company. I think this is a little bit under the radar, but it's an interesting dynamic that should be discussed furthermore. And fourth, on the margin question, they kept it pretty open. In a sense, they kept saying that we are long-term, we have good products and services, and that the earnings and the margins are going to be a result of our endeavors and not part of the plan necessarily. I want to dissect that a bit, because overall I think I'm okay with that. The street is interpreting it as sort of lowballing or something along those lines. I don't think we need to do that. So this is not even on podcast. It's July 20th, 2023. This is Krim Delco. Since the last update, we're down 16%. The market is down 20 basis points. For the year, we are up 134%. The market is up 18.4%. We're outperforming by 115.6%. Tesla's earnings call was, I would say in a nutshell, a little bit disappointing on the content side. Elon Musk was on the call. He sounded almost drunk. I don't think he was drunk, but it was kind of a superficial attitude of humor, of comments that are not necessary, and they're taking it lightly as far as the magnitude of what it means to be on an earnings call is concerned. Now, that of course has implications. You can say that that is a bad sign, the company's going the wrong direction. You can say that, Tesla is just doing it differently and wants to distance themselves from corporate America. I think it goes both ways. To me, that's not terribly concerning. Did I feel that the employees are sort of under a spell there, that they have to pretend to having fun while Musk is making jokes? I don't think so, but that's another risk. So it's not 100% clear what's going on as far as that's concerned. But overall, I would say the call was one of those calls that was less urgency, less content, and more just babbling. So that's, for lack of better words. But let's get to the content. Still, there was a lot of content, of course. I don't want to diminish it. This is still a very, very important company with lots of interesting content. And to some extent, also, we're getting tired of hearing the same thing again and again. And that is not Tesla's fault. That is just the fact that we are incredibly focused on the company, and we hear the same things, like, for example, the robotaxi story. Is Musk the boy who cried robotaxi at this point, or is this just really just babbling about something that never will happen? I mean, those are questions that are important for Tesla investors that we can't answer today, that we can't answer after this earnings call. And there just isn't enough substance to be delivered right now. So let's start with the points. I want to start with the AI story, which I think is the most important story in the last couple of weeks. The AI story is the following. So we have a new ImageNet moment in AI, which is generative AI, started by ChatGPT and what happened with OpenAI, and now is proliferating throughout the system. What it means is that, look, you have the ability to generate let's say pictures, to generate content based on transformers. You have the ability to replicate reality in vector space and then reproduce it back into some space that is useful for you. That is a new thing because it's been shown to work really well for certain problems. Now, what is the ImageNet moment? The ImageNet moment is the moment in 2012 when Jeff Hinton, Ilya Sutskever, and people like that showed in a paper that classifying pictures based on neural nets and supervised learning is a much stronger technology than other technologies available back then. So it started an AI revolution, which took me to take a course with Andrew Ng about machine learning, and I think I wasn't the only one. Silicon Valley exploded as far as AI is concerned. Today we have another moment, it's the ImageNet moment, which is driving people towards things like large language models, stable diffusion, and other types of AI concepts that could be useful for all kinds of applications. As far as Tesla is concerned, the main application is, of course, robotics and the self-driving car. Humanoid robot also as a tangent to that. Those are the two big applications for Tesla. And Musk said on the call that he was ready to hire more talent into his AI endeavor, and that they didn't want to work for Tesla. And that's why he started XAI. I think that's an important piece of information that that people have to digest. While I'm on this note, I just want to mention another very important piece of information as far as AI is concerned is the fact that Tesla is in talks with an OEM to license FSD. I think that's important. I think we can't emphasize this fact because it's important. It is just important. The implications of that could be magnificent for Tesla shareholders, and it has a pretty big impact also on the way self-driving might continue. People look for analogies here with the charging standard. So if Tesla could become the self-driving standard of the world, of course, or at least North America, well, that could go a long way. So again, I think that the AI question is in the open. It's important. It's key. I think it's something that this earnings call will go into history as being a pivotal moment as far as the AI endeavors of Tesla are concerned. I think in conjunction with the Twitter Spaces of XAI, but that happened last week. So those are two important events that I think investors are now slowly digesting. The direction is not clear. Of course, we hope that the direction is to the positive. That means that the people that Musk hired into XAI will be able to come up with new interesting concepts that can be translated into better applications for Tesla customers and therefore increase the value of the cars and the company. That is the hope. It's not clear, but of course, again, this is a pivotal moment. There's something going on. It's important to notice that. My partner, for example, in our morning meeting today said that she was a little bit disappointed. There wasn't enough engineering comments. There wasn't, talk about, let's say, new glues that help Tesla produce things better, although that was mentioned a little bit. But just things along those lines that typically excite Tesla investors, just hearing about new types of material science applications that could make a huge impact on the production side of things, on the cost side of things. So there wasn't much talk of that. However, there was talk about AI, and I think AI is the story of the moment. And therefore, we want to put that down as point number one of the earnings call, that we think that AI is in the move, that it's important that Tesla, particularly Musk, is moving, that it's a little bit disappointing that he has to start a separate company, that it can't be done within Tesla. In other words, also the talent that is being hired, why aren't they excited about working for Tesla? Those are questions that aren't answered, that haven't been answered properly, I would say, and that leave question marks open. I would consider this AI point, at this point, I would say neutral to slightly positive. I think the second point I want to make is about the Cybertruck, sluggish start of the Cybertruck. Look, that's something that we just have to live with Tesla. When a new product comes online like the Cybertruck, of course, we're desperate to get this thing on the road, not just as shareholders and as sort of earnings contribution or anything like that. It's just like we want to see that thing. We want to buy it ourselves. So there's a lot of that going on. And the question, of course, is why is the ramp sluggish? The story that Tesla's giving us is similar to the Model X story. It's a complex technology. There's lots of new technology. and it just takes time, which is understandable, of course. I mean, things go wrong. You don't want to bring a product online that is not working well, I think, etc., etc. So that is the story here. As far as implications for investors, of course, number one, we have less contribution from the Cybertruck in the near term. That is going to maybe hamper growth expectations, and those sort of things. The management went out of their way to emphasize the long-term value of the company, to emphasize the discounted future cash flows, and saying that, look, current cash flows and current earnings are less important than future. This is what they were saying. Now they gave us a sort of lesson of investing 101. My partner, again, in the morning meeting said, why are they doing this? Why are they doing this? I think they want to emphasize the fact that in a company like Tesla, future cash flows, particularly far out future cash flows, have a lot larger impact on valuations than near cash flows. So then you have to think about, as an investor, well, how do you gauge the future cash flows? And there's a theorem, I don't know if it's a theorem, but there's definitely a sort of, there's a wisdom in the markets which says the best predictor of the future stock price is the current stock price, right? So if you take those two into account, then you have to say, well, look, the present matters. The present is not just something out there, some abstract thing. It does matter, and we can't just dream about the future. Musk said another thing, which was that as a shareholder, you should buy long-term. You should buy the company with the best products and services. I agree with that. Actually, I just had a call recently in conjunction with Johan Cruyff's book. Cruyff talks about the game. Musk talks about the product. I don't want to go into details, but I'm just saying, look, in the end, when you are exposed to complex situations like investing, or let's say, world football, in the case of Johan Cruyff, you sometimes lose orientation a little bit. You lose focus, and it's valuable to get back to what actually matters. And what matters, first and foremost, is it's just simply the game, or the product and the services. There's one caveat here, and the caveat is that I have to, ask myself sometimes, well, okay, I can have good products and services, but let's say Uber is a good service, but the product is not profitable, and therefore it's not a good investment, and things along those lines. So I think you have to sort of add to that, and Musk did that in the past, good products and services with profitable, positive cash flow, because cash flow is a metric for how well the business is run and how well the cost structure is in line with the product and the service. So I just add that as an investor to this context. But again, back to the Cybertruck and the comments of management. The Cybertruck is important because it's going to generate lots of revenue for the company. And it's important also as a proof of concept that Tesla still has it, that they can deliver new products and services at the magnitude of a Cybertruck. The sluggishness of the ramp is, to me, not too big of a concern, because they will figure it out. This is about iteration. Like I said many times, disruption is about iteration. Iteration requires iteration, try and error. You try things and then you fix mistakes, and that's what they're doing with the Cybertruck. The third thing that was mentioned on the call was a delay of Q3. This is now very immediate. So Q3 is going to be a little bit less production, meaning no production growth. I think that's the most minor point. It just means they're drawing down inventory. They're also retooling for Project Highland and stuff. Look, I'm not reading too much into this. I'm sure the street is going to be okay. Demand is sluggish, and they said on the call that we have still macro issues, that we have this, we have that, we have high interest rates. All of those things were mentioned. And I think actually, as a sort of silver lining here, they did mention in the shareholder deck that they're actively working on finding better financing solution for people. In other words, they want to lower the interest rate that people are paying on cars, or at least reduce the rejection of auto loans and those sort of things. I think that's laudable. It didn't come up in the call, actually, which is interesting. But I think that's a very important thing, because Tesla has done it before with insurance. I guess they're going to try to get into financing of cars, because the financing of cars now, with the banking crisis and the loan applications being rejected, is hampering the growth for Tesla. So this is actually opening the door for a whole new chapter for Tesla, which could be that Tesla becomes a financing bank. Now that has, again, two types of interpretations. One is you can say that's great, Tesla should be in that business the same way they're in the insurance business. It will also increase the incentive for Tesla to increase residual values, for example, the same way, the closed loop idea with insurance. Idea is the right word here, because I'm not sure how much there is really on the ground going on in terms of, let's say, are they really producing cars with the insurance product in mind? Are they going to produce cars with banking and residual value in mind? I'm not so sure about that, but it's a good starting point. And what do I mean with that? Let's say, what does closed loop with insurance mean? It means that when you design the way the production of the car, you're already thinking about potential accidents that could be going onto your balance sheet as a company that is providing insurance. So you're trying to reduce the cost of repairing cars. And that is, of course, a very massive change in the insurance market and the way car companies think, because traditional car companies actually make their money with aftermarket services. So they have an incentive to make everything a little bit more expensive aftermarket, and Tesla is trying to change that. Right now, I don't know exactly where they stand. Fortunately, I never had a big accident or anything like that, so I haven't felt it as a customer. What I felt as a customer is that, for example, when it comes to things like tires and I once had a flat tire and I had to be towed, and that kind of thing was the same nightmare like if I had a BMW or a Mercedes. So there they didn't really have a solution that is better for me personally as a customer. But we'll see how that turns out. Again, I think Tesla thinking big picture into the financing situation of a customer, I think is an important piece that has been added, to my knowledge, to the shareholder deck. I've never seen that before, so that's interesting within the context of them slowing down production in Q3 and therefore possible demand sluggishness. I think all of that is important. It's important to be noted, but it's not. It doesn't actually. It's a prudent thing to not to build too much inventory, and therefore I think it's a good overall strategic move, but a little bit disappointing from an investor perspective. You'd want to see more growth, and you'd want to see more aggressive growth, and you don't see it right now because the macro situation supportive. I would say that if Tesla can grow deliveries in the mid-30s%, and we have a decline of the car market of 15%, and that puts you at around 50% adjusted growth, or even more if you think about it, that they're basically growing their deliveries excuse me, in the mid-30s, while we have tailwind. So we're swimming against the stream here. And that, to me, is testament enough that the demand for Tesla is very strong. I think the fourth point I want to make here is about margins. And this is a bit of a longer conversation. It almost warrants its own episode, but still I want to do it here in the context of the earnings call discussion. Now, first, the fact is that they're pretty elusive about margins. They don't want to commit. They basically saying margins are going to be the result of our actions, not the aim. What that means is that all the things we're doing as a company we're trying to make the best products and services at the lowest cost possible, and then the margins will be the result of all these actions. Musk then also spoke about buying a stock for its product, for the company's products and services, and that the company with the best products and services eventually ends up winning. In other words, also ends up making money, ends up having the best margins. And then also Zach Kirkhorn added to that they have industry-leading margins. They want to continue with that, but that they don't want to commit today about the actual margins, let's say for Q3, Q4, etc. What that means in concrete, of course, is that they don't want to commit to the ASP, because margins are really a function of the price you sell something for minus the cost that it takes you to produce that thing. That's what margins are. And they can control the cost to some extent, particularly now with declining cost. That is easier. What they can't control is the price that they're selling the thing for, in other words, ASP. So that's the fact, that's the situation. For shareholders, I think that's actually a good thing. I would say to me, that is the way a company should communicate. Why? Like, imagine you commit to margins as a company. Imagine you say, I'm delivering X margins. That's the goal of the company. Well, you're going to be volume constrained. You're going to constrain yourselves in many ways because margins are like, it's almost like saying that a coach commits to the result of a team and therefore is almost constrained in any other way. Versus how about I commit to the actual training, the best talent on the pitch with the best, strategy, and then the result will take care of itself. Like Bill Walsh, the former 49ers coach, wrote famously in his book. I think this is the score takes care of itself in business context, and Musk is very committed to that. He's using Buffett, for example, as an example to illustrate that. So you buy the company which commits to the best products and services, you hold on to as long as you can, because that is really how you generate wealth. By the way, this is very similar to our interpretation of the degrees of freedom as an investor. We spoke about this years ago. I can put the episode in the show notes, where we spoke about what are the actual degrees of freedom you have as an investor. And the only degree of freedom, we said we only have one degree of freedom, which is, in or out. Either you're in or you're out. That's the only thing you really can control as an investor. And the way you do that is by finding the company with the best products and services that long-term can generate the kind of value that will generate wealth. Generating wealth is a tough thing because you have to not just make money as a company, right? You have to do that throughout the volatility of macro. You have to deal with tax regimes. You have to deal with the investors. As an investor, you're also exposed to leverage, and leverage is not just the kind of credit you're borrowing against when you buy stock. It's also your own life. I mean, you have costs, you have circumstances in life. You want to send your kids to college, things like that. These are all expenses you have, or leverage if you want, because you're going to have to need that money. And as an investor, you need to live with that, like it or not. You have to incorporate all these things. In other words, if my kid goes to college and I have a $500,000 bill coming up for tuition over the next 4 years, well, the stock market doesn't care about that. The stock of the company will not care. If the stock's down 72%, like last year, I will have trouble paying for that. So there are things along those lines that we as investors have to be aware of, and that Musk certainly cannot help us with. He, as an entrepreneur, the only thing he can do is provide the best products and services at a decent cash flow. Therefore, make sure that the best products and services are delivered within a cost structure that is sustainable. And that's really what they're saying. So to end the long story short here, the questions on margins were not answered other than saying, look, long-term, this company will create lots of wealth. In the short-term, margins are volatile. We can't control that. And as an investor, you have to live with that. Now, we do commit to profitability. We want to make sure we're funded properly. We want to make sure we deliver positive cash flow, which they are doing, even positive free cash flow, within the context of large investments that are coming up. That is an achievement. And you also have to believe as an investor, of course, that the investments that are going into the company, so the difference between operating cash flow and free cash flow is capital investments, which according to the rules of finance just means that stuff which is being invested in that should generate returns in the future. So you should believe as an investor, or hope, or be happy with, depending on where you stand. But you should definitely account for those investments and think about them as, are they going to be profitable? That's the key. And that goes back to, this is Finance 101, right? The best use of cash of a company is always the investment in its own business. As long as you can invest profitably, which means above your cost of capital, then you should keep doing that. A lot of companies don't have that luxury, and that's why their stocks are sluggish. The stock market is a pretty constrained situation. So the stock market really is very, very similar to an apple falling from the Tower of Pisa. It's constrained by gravity. by the laws of physics. It's just that those laws of physics and gravity have different names. We call it finance, we call it return on investment, we call it cost of capital, these things have different names, but the dynamics are the same, which is a stock is really like an apple, going through space, abiding to laws of finance. And the laws of finance are that the more profitable growth you can generate with the cash you generate from the company, and the higher your return on investment is, and the larger the difference between the return on investment of the company and its own cost of capital, the larger the wealth creation of the company is. This is what Musk kind of said in his own words to the question of margins, similarly Zach Kirkhorn. And I personally, I'm very happy with that. The street is not happy, but that's irrelevant. This goes back to even linguistics. This goes back to talking about different things. So where you have an earnings call, you have a quarterly earnings call, people want to hear the typical blah, blah, blah that they hear from all other companies. Tesla isn't delivering that message. Tesla's delivering a different message. And now you as an investor, you can choose on which side you want to be. We're on the side of Tesla. We acknowledge the risk. It could go wrong. These investments could be wrong. But the fact that we have the opportunity to participate in a company that has the chance to reinvest its own generated cash at a much higher expected return than its cost of capital, and therefore create value for us, that is a privilege that we appreciate. So to summarize, the 4 big points from the Tesla Q2 earnings call 2023 are: number one, the AI is really important and it's happening. Something new is happening, and Tesla reiterated that. Number two, the sluggishness of the ramp of the Cybertruck is disappointing, but it's a fact of life when you bring new technology to market. Number three, we have a slowdown in production in Q3, which is a drawdown on inventory, which this is disappointing because we would like to see more aggressive growth. And number four, the margin question, which is being answered, in our view, in the correct way, and that is margins are a result. The score takes care of itself. Thank you.